We all can't afford to be shorting stocks. The second best way we can do that is with short synthetic stock positions with options. And all that is when a trader buys an at-the-money put option and sells an at-the-money call option at the same time. This is a bearish position on a stock, and you do not need to own the stock. You do not need to borrow the stock to do this. And one reason we like to trade options at NetPicks is because we get to take advantage of the movement of expensive stocks without that capital requirement. For a fraction of the amount of buying or selling a stock, we can make money. And some of our strategies, we can make money up to 5 different ways with the same price movements of the stock. Now, of course, there's always risks in trading. With our synthetic shorts, there's some risks that we need to know. Remember, we're using leverage. An options contract typically controls 100 shares of the underlying security. So your losses can be magnified if that trade does not go your way. Second, there's always the risk in options that one side of your trade gets assigned, meaning you're going to have to buy or sell the shares of an underlying security at the strike price before you're able to close out your position. Now, this can really happen if there's a sudden news release that impacts one side of your trade more than the other. In case of our short trade, the risk potential is unlimited because that underlying instrument can rally. And a losing trade is going to occur when that price of that underlying asset is greater than the strike price of that call plus the premium we received. What are the positives? Because there are some. These are going to allow a trader who does not have enough money to buy shares or sell shares outright to get exposure to that security. So when we trade options, we do not need the same capital as if we were buying the actual underlying or selling it. So we get to take advantage of different market conditions because we can profit from rising markets, falling markets, and some of our option strategies that we use, our risk is fully defined. The profit potential on these synthetic trades short, it's unlimited because a stock can potentially go to zero. Because remember, you bought a put option and that gives you the right to sell that stock at the strike price. And we achieve our profit in these trades when the price of an underlying asset is less than the strike price of the put option plus the net premium that we got when we sold the call option. Now, knowing when you're at break even, it's absolutely essential to proper management of your trade. To calculate, it's pretty easy. Take the strike price of the long put plus the net premium that received. So for an example, let's say you bought a $50 put for $2. Buying a put means you're short, and you sold a $50 call for $1. Again, short. Your break-even point is $51. That's the $50 strike price plus the $1 premium that you received for selling the call. And as with any trade, the key to success is your proper risk management. You always have to have a plan in place before you consider pushing the buttons. So let's take a short example here, and this is TRIP. And let's say it's currently trading at $23.31, which it was when I took this screen capture. I want you to keep in mind, again, each options contract is 100 shares. So I would need about $23,000 to short 100 shares of this stock. It's pretty capital intensive, if you ask me. But if I use a synthetic short trade and the strike price of 23, I will buy an at-the-money put option for $1.38. I would sell an at-the-money call option for $1.52. That's the premium I would get. So the put option would cost me $1.38 times 100 shares. It's $138. If I sold the call option, that's going to give me a credit of $1.52 times 100 is $152. So my net premium is $14. So on the expiration date, if TRIP is trading at $18, so it's gone down, that call option it's going to be worthless because the buyer of that call would, in most cases, not exercise the right that they have. The put would expire in the money and would be approximately $500. We had a $5 a share decline times 100. The net premium received was $14, so my gross profit would be about $514. And that's pretty close to what you would get if you shorted the actual stock, but you need a heck of a lot more capital to do it. On the flip side, if TRIP rallies to $28, so it goes up $5, now my put's going to expire worthless on expiration day. The call that I sold, it's in the money, has an intrinsic value of $500. My loss, if that was exercised, would be $500 minus the net premium received of $14. I would lose 486. Here's some quick facts just to round this all up. A short synthetic stock position, we create that when we buy an at-the-money put option, and then at the same time we sell an at-the-money call option. It's bearish. We do not need to own the stock. We do not need to borrow the stock. And one reason that we love options is because we get to take advantage of the price movement of expensive stocks or ETFs or whatever we're trading without needing the huge capital. And there are a lot of benefits to creating these synthetic positions, but there's risks. The most important thing to know is what the risks are. First, you're using leverage, right? Your losses can be magnified if that trade doesn't go your way. Second, there's always the risk that one side of your trade will get assigned, meaning you're going to have to buy or sell shares of an underlying security at the strike price of the option. Anyways, thanks for checking out this video. Make sure you hit like, hit subscribe. We'll talk to you soon.